let's touch upon the macros. And you've got the rupee, which continues to gain trajectory against the US dollar on account of increased selling of the US currency by exporters and banks. Besides that, you also have the strengthening of the yen and some of the other Asian currencies against the dollar, which is supporting the rupee as we speak, 54.77. For the bond yields, in fact, they touch fresh lows at close to 7.43% at the lowest since May 2010. We'll also be watching out for the new 10-year bond, which will be auctioned tomorrow. Let's get in Madan Subnavis, who's the chief economist at CARE Ratings, to talk about that and lots more. Madan, afternoon. Great to have you with us. To start off with, it's that new bond yield which is going to be auctioned tomorrow, the 10-year bond rather, and a few experts say that it could even likely trade below 7%. Do you think that's possible?
No, maybe not in the immediate run, but definitely there is a downward tendency as far as we're talking of the 10-year bond. And I think this could be attributed more to the positive sense of sentiment which has evolved in the market on account of low inflation numbers and a very high expectation that the RBI would get a bit more aggressive in terms of lowering interest rates. That combined with the fact that there is not too much of growth in bank credit could be the main factors which have been driving the yields low. But still, I would tend to think that it's more being driven by sentiment, because if we're looking at the repo window, we're still talking of something like 1 lakh crores which is being borrowed by the banks from the RBI. So there are fairly contrasting signals which we see in the market today, but on the whole, I think the tendency would be for rates to drop further.
But would the rate cuts or any action by the RBI already be in the prices, Madan, or do you believe there is a possibility that bond prices might go higher from these levels?
No, not in the immediate run. So I'm talking of an immediate run, I think right up till the time we have the next policy announcements, because that's where the sentiment really lies, thinking that the RBI is going to be a bit more aggressive in lowering rates. So I think we could be seeing this downward tendency towards the mid-June or so, or until such point of time that we really see a pickup in bank credit. Right now we're not seeing too much of demand for credit, so that would be another factor which is contributing towards the easing of GSEC yields.
With the liquidity deficit remaining high, how do you see the RBI managing the liquidity? Do you think that what we really need is a combination of CRR plus, OMO operations at regular intervals?
No, I think the RBI would probably prefer to go in for an OMO as and when it's required, because the CRR, even though it does the CRR and the OMO are analogous in the sense that both of them release liquidity into the system. But the moment you go in for a CRR, it's more a signal of saying that the RBI is going to ease monetary conditions. It's an ease of monetary policy stance. And that would probably go along with a rate cut as and when the RBI decides to do it. So I think as of now, the RBI may probably prefer to go in for open market operations and look at the CRR cut only as and when it's required to send a strong policy signal that the RBI really wants to ease monetary policy significantly, so that it would help for the economy to pick up.
Madan, I asked this to everybody the last 3 or 4 sessions, just wanting your view too. You think the numbers that came in the trade deficit for the month of April were an aberration and May could show a marked improvement?
See, May will show some kind of an improvement, because I think what we have seen in April was more on account of the high import of gold, and we have the festival going on or just gotten over, so this is a time when people will also tend to buy more gold. So I would expect the pressure to remain even in the month of May. Probably it may not be as substantial as what we saw in April. And given the fact that the price of gold internationally also seems to be dropping, it's been very volatile as the Sensex, and we are probably looking at a situation where the prices could be easing a bit downwards further in say the next month or so. There could be an increase in demand for gold. So even though the RBI has put certain measures to try and curb the import of gold, I think our natural tendency to buy more gold would remain, and therefore to that extent there will be some pressure in terms of our import bill. This combined with the fact that any kind of a recovery in the economy would also necessitate a higher import of non-oil goods would also be tending to put pressure. So I would tend to think that the trade deficit would continue to remain under pressure in the month of May, but it may not be as significant as what it was in April.
Madan, let's talk about the inflation numbers, because no doubt that lowering headline was a big relief to the markets, but a closer look at the numbers suggests that it's perhaps only the base effect which is at play, and that this sustained level of inflation is now unprecedented. Do you agree?
No, I would fully agree with you that most of the reasons for the fall in the inflation rate is because of the high base effect. Because if you go to the marketplace, you realize that you're still paying very high prices. And if you tell the common man that the inflation rate has come down, he'll probably think this is a joke and we won't be trusting economists for what they say. But unfortunately, or rather fortunately, whichever way we look at it, this particular number is the number which actually guides policy decisions. And therefore we go by how the WPI or the CPI have been behaving. And the trend has been that it's moving downwards, and therefore it's a positive news as far as the market is concerned. It's positive news as far as the RBI is concerned. But I think as far as the common man is concerned, the grief remains as it was, because we really don't see prices coming down. And the earlier years when we used to have the situation of a harvest season leading to lower food prices doesn't really bring down the prices of food. What we really see is moderation in terms of the rate of change of increase in prices. And then that's what we are calling food inflation getting moderated. So I would fully agree with you. It's basically the base effect which has tended to bring down these numbers. But it's significant because that's what our policy framers are going to look at when they're taking any further action, especially on interest rates.
Speaking of the food inflation, although it did ease to 6.1%, you also have the food grain inflation that continues to remain in double digits. Now, given that the government is also now looking at an ordinance to make the food security bill a reality, are we likely to see a further notch up in these prices?
So there will be a tendency for the prices to increase, not so much on account of the food security bill. I think that's more hype, saying that food security bill is going to increase prices. I would tend to think the normal tendency of the Ministry of Agriculture to increase the minimum support prices would be the reason as to why inflation would continue to remain high as far as food grains are concerned. Because now we're talking of the Kharif season sowing to begin from the month of June. So very soon they're going to announce the minimum support prices, which would definitely be increasing by another 8 to 10%, which has been the trend in the last 5 years. So higher minimum support prices would definitely get translated to higher food grain prices in the coming months.
No doubt the two niggling factors when it came to the current account deficit was the way gold as well as crude oil prices were panning out. Given that we saw a sharp decline in that, how much do you see it aiding the overall current account deficit, and what's the figure that you're now penciling in?
So there will definitely be an improvement in the current account deficit in the current financial year, because we're talking in terms of some kind of recovery taking place in exports. We're talking in terms of crude oil prices remaining almost where they are, or with a movement towards downward movement rather than an upward movement. These two factors combined, I think, should be keeping the current account deficit at somewhere between 4.5% to 5%. I'm not too optimistic about it coming down below 4.5%, because we won't be expecting our exports to go towards the 20% growth rate. It will probably be more towards the 7-8% growth for this particular year, because the first month also hasn't been very encouraging, and we need global conditions to improve significantly, and we don't see too many signs of that presently. The news coming from the Euro region doesn't really sound very encouraging for us in terms of our export markets. Of course, our exports are geared more towards the African and Asian economies, which will probably help to get hold of this number of 7 to 8%. But on the whole, I think the current account deficit would be more in the region of around 4.5% to 5%, lower from what it was in 12-13, which would be around 5.3, 5.4%. So that would be some kind of an improvement. But I think our policies will still have to be geared towards attracting the capital inflows so that the balance of payments remains sustainable.
Leave it at that, Madan. Thanks so much for taking the time out and joining us.